Welcome to the deep dive. Today, we're pulling back the curtain on a topic that might sound a little dry, maybe a bit accountant-y at first, stock compensation. But trust me, stick with us because it's actually packed with some pretty surprising insights into how companies motivate their teams and what it means for their financial health. So our mission today is simple. We're taking the detailed source material you've shared with us, and we're going to unpack every layer. We'll cut through the jargon and hopefully reveal the, surprisingly clear logic behind things like employee stock options and stock appreciation rights. Our goal: make sure you walk away truly well-informed, ready to spot these concepts out there and really understand their impact. All right, let's dive straight in. The first big one, the stock option. What exactly is it? At its core, it's pretty simple. It's a right for an employee to purchase shares of the company's stock. But there are specific conditions, right? Fixed price, set time frame, certain quantity. And the common scenario, this is important, is that companies often grant these options at a price below what the stock is currently trading for.
So, right out of the gate, there's this potential profit baked in for the employee. That's a pretty massive incentive.
It is. And what's truly fascinating here is the dual purpose. Yes, it's compensation, absolutely. But maybe more strategically, it's a clever way to get employee interests aligned with the company's long-term success. You succeed, we succeed, that kind of thing. And most agreements, they also include a minimum holding period or retention period.
Oh, okay. To stop people just flipping them quickly.
Exactly. It prevents that quick speculation and encourages, commitment. And from the company's side, the cost of this compensation, well, it's measured by its fair value, usually based on some kind of option pricing model.
Okay, fair value. So what does this all mean for the company's actual books, their financial statements? Because here's where it gets, really interesting, I think. Not all stock options get the same accounting treatment. They can be either non-compensatory or compensatory. That difference is huge. Let's say we start with the non-compensatory plans first. These are the ones where the company doesn't actually record a compensation expense, which might make you think, wait, how is that possible? Isn't it compensation?
Right. And the critical implication here, the why, is that companies typically use these plans less as direct payment for work and more for broader goals. Things like raising capital by getting employees to invest directly, or maybe diversifying ownership among a wider base of the staff. And a key insight, companies, maybe startups, or those really watching their reported profits, they might lean towards these non-compensatory plans specifically because they avoid hitting the income statement with an expense.
So it improves the reported profitability, at least on the surface. Makes sense for optics.
Exactly. It can be crucial for those financial metrics.
Okay, so what makes a plan non-compensatory then? There must be rules, right?
Yeah.
Under U.S. GAAP, generally accepted accounting principles.
Yeah, there's some very strict rules. First, pretty much all full-time employees who meet some basic qualifications have to be able to participate. Usually excludes top officers or people who already own a lot of stock. Second, the stock has to be offered equally to everyone eligible. Though, okay, there might be a limit on how many shares one person can buy. Third, the time you have to actually exercise the options to buy the stock, it has to be limited to a reasonable period. You can't just sit on them forever. And finally, and this is key, any discount from the market price can't be more than what would be considered a reasonable offer to existing shareholders or, other outside parties.
So if and only if a plan meets all of those requirements.
All of them. Then the company doesn't recognize compensation expense. It avoids that hit to the income statement. That's the crucial distinction. It directly impacts reported profit. But if a plan doesn't meet all those characteristics, then it's usually classified as compensatory. And that's where things get, let's say, more involved. That's where a cost is recorded.
Right. Okay, so let's dive into those compensatory plans now. These are the ones valued at the fair value of the options issued. And crucially, they do result in a compensation expense for the company. This is where you really see the impact show up on the company's income statement, affecting their bottom line. Now, to really get these, we probably need to nail down a few key definitions, sort of the building blocks for how this all works. You got the option price or exercise price. That's just the fixed price the employee pays for the stock. Then the exercise date. Pretty straightforward, the deadline by which they have to use the option, the fair value of the option. This comes from an economic pricing model, like Black-Scholes is a common one.
And the good news for anyone listening, you generally don't have to calculate this in practice or, for exams. It's usually given.
Thank goodness for that. Okay, then the grant date, simply the day the option is issued, the vesting period. This is the time the employee has to work to actually earn the right to exercise the options. It's the period from the grant date until they're fully earned or vested, and finally, the service period. This is the time frame over which that compensation expense gets recognized on the books. Usually, it's the same as the vesting period. It represents the time the employee is doing the work they're being compensated for with these options.
Exactly. And building on that, the logical next question is, okay, how does the company actually calculate this expense and record it? Well, under the fair value method, the total compensation expense is measured using one of those acceptable models, like Black-Scholes, right on the grant date. You figure out the total value then. Then, importantly, this total cost isn't recognized all at once. It's allocated, spread out over the service period.
The matching principle from Accounting 101.
Precisely. It ensures the expense is matched to the periods where the employee actually performs the services that earned them those options. Very fundamental.
Okay, theory's good, but let's make it concrete. We've got an example from our source material. Let's talk about ABCCO. On January 1, year 1, they granted options. These allow employees to buy 10,000 shares of their common stock, which has a $5 par value, for $25 per share. And these options, they only become exercisable after December 31, year 2. So that tells us the service period is 2 full years, year 1 and year 2. Now, on that grant date, Jan 1, year 1, the actual market price of the stock was only $20 per share.
So the option price is actually higher than the market price at grant.
Right, which seems counterintuitive, but remember, the value is in the option itself, the potential for the stock price to go up over the next 2 years. And using a valuation model, ABC determined the total fair value of all these options together was $50,000. It's explicitly compensation for work done in year 1 and year 2.
Okay, so 2-year service period, $50,000 total compensation cost. That means, logically, the $50,000 gets spread evenly over year 1 and year 2, right? $25,000 per year.
Exactly. Matches the expense to when the work is done. So let's walk through the accounting entries. What actually happens on ABC's books? On January 1, year 1, the grant date, nothing. No journal entry needed yet. The fair value is determined, yes, but the service hasn't started, so no expense recognized. Now, fast forward to December 31, year 1. End of the first year. 1 year of service is done. So we allocate half of that total $50,000 expense. That means ADC records $25,000 as compensation expense on their income statement. That directly reduces their profit for year 1. And the other side of the entry, they credit $25,000 to an equity account called Additional Paid-in Capital Stock Options.
Right. APIC, additional paid-in capital. That's generally money investors paid above par value. This specific APIC account acts like a temporary holding place on the balance sheet. It represents the value of these options that haven't been exercised yet, but reflects the future equity claim the employees have earned so far.
Okay, got it. Now, December 31st, year 2. End of the second year, same process. Another year of service completed. So another $25,000 gets recognized as compensation expense, hitting the year 2 income statement. And another $25,000 goes into that additional paid-in capital stock options account. So now at this point, the full $50,000 total compensation has been expensed over the 2 years, and that APIC stock options account on the balance sheet holds the full $50,000 balance.
Yeah.
The options are now fully vested. Employees have earned the right.
They've done the work. The cost is recognized. Makes sense.
Now the payoff. January 1, year 3, the exercise date. Let's say all 10,000 options are exercised. The market price has shot up to $35 per share. But employees still get to buy at their fixed exercise price of $25.
Big win for the employees there.
Definitely. So what happens to the company's cash and equity accounts? First, cash comes in, $250,000. That's the 10,000 shares times the $25 exercise price. So cash goes up. Second, that additional paid-in capital stock options account isn't needed anymore. The options are being turned into actual shares. So its full $50,000 balance is debited, essentially zeroing it out. Third, the common stock account is credited for the par value. That's 10,000 shares times the $5 par value, so $50,000. And finally, the rest goes to the main additional paid-in capital in excess of par account, sometimes just called APIC common stock. That remaining amount is $250,000. It's a cash received, $250K, plus the value transferred from APIC options, $50K, minus the par value, $50K. So $250K plus $50K in APIC, $50K, all $150K. Or simply the total value recorded in equity is the cash received plus the original fair value expensed, $250K plus $50K plus $300, split between par, $50K, and APIC, $250K.
Right. It's basically a reclassification within the equity section of the balance sheet. The company issues stock, gets cash, and shuffles the related equity accounts around. Okay, but here's a practical question. What happens if some options expire? Maybe the stock price didn't go up enough, or an employee leaves before exercising. Does that change the expense already recorded?
Good question. No, it doesn't. If options expire, the balance sitting in that additional paid-in capital stock options account for those specific expired options just gets moved.
Moved where?
It's reclassified, usually to another equity account like additional paid-in capital expired stock options. So in our ABC example, if only half the options were exercised, the $25,000 related to the expired half in APIC stock options would just be relabeled, essentially.
Well, okay, so the crucial point is the compensation expense that was already recognized back in year 1 and year 2, that stays. It's not reversed.
Exactly. That expense reflected the service performed during those years. The expiration is just an internal balance sheet adjustment within equity. It doesn't affect past income statements. Okay, let's shift gears a bit. There's another important type of incentive. Stock appreciation rights, or SARs. Now, while stock options involve the employee actually buying shares, paying cash, SARs are different. A SAR gives an employee the right to receive an amount, and importantly, this can be either cash or shares equal to the increase, the appreciation in the stock's market price.
Increase over what baseline?
Good point. It's the excess of the market price on the exercise date over a predetermined price, which is usually the market price back on the grant date. So they get the value of the stock growth.
Okay, so what's really distinct here, and this is absolutely key for the accounting, is that SARs don't require the employee to pay anything to get the benefit.
Right. No cash payment from the employee, like with options.
Yeah. And that changes the accounting quite a bit. The company isn't getting cash in when these are exercised if they're settled in cash. Instead, that appreciation amount, multiplied by the number of rights, gets recorded as compensation expense. But crucially, because the company owes the employee something later, cash or shares, it's also recorded as a liability on the balance sheet if it's going to be paid in cash.
A liability, not equity like the options.
If cash settled, yes. If it were to be settled in stock, then you'd credit additional paid in capital, similar to options. But for cash-settled SARs, it's a liability. And here's another big difference compared to those fixed fair value stock options we just discussed. The compensation expense and the liability for SARs aren't fixed at the grant date value. They have to be adjusted every year based on changes in the stock's market price, right up until they're exercised or expire.
Whoa. Okay, so the expense can go up or down each year depending on the stock price.
Exactly. It makes the accounting much more dynamic, much more volatile maybe, because it reflects the current market value of that obligation each period.
All right, let's nail this down with another example from the source. Let's look at Loud Corp. On January 1, year 1, Loud granted its president, Mort, 10,000 stock appreciation rights. They expire quite a bit later, January 3, year 4. Mort gets cash for the appreciation, the excess of the market price on exercise over the market price on the grant date. And the service period is 2 years again, year 1 and year 2. Now for SARs, tracking the market price is absolutely critical. So here are the prices. Jan 1, year 1, grant date. Market price was $30. That's our baseline. Dec 31, year 1, price jumped to $45. Dec 31, year 2, dropped back a bit to $40. And finally, Jan 2, year 3, exercise date. Mort exercises them, and the price is still $40.
Okay, so we've got these fluctuating prices. How does LoudCorp actually account for this changing value each year? It's not that simple fixed $50,000 total cost like the ABC options example.
Right, it requires year-end adjustments. Let's walk through LoudCorp's books.
Yeah.
First, December 31, year 1. Market price is $45. Grant date price was $30. So the appreciation per right is $15, $45, $30. For Mort's 10,000 rights, the total potential appreciation value is $15 times 10,000, which is $150,000. Now the service period is 2 years. So at the end of year 1, we recognize half of the service, so we need to account for half of that $150,000 appreciation related to the service performed so far. That's $75,000.
So year 1 expense is $75,000.
Exactly. The journal entry is debit compensation expense $75,000 that hits the income statement. A credit liability for SAR plan $75,000. That liability appears on the balance sheet, showing the obligation LoudCorp has accrued to Mort based on year 1 service and year 1's closing stock price.
Got it. Accruing for that a future cash payout.
Okay, now let's move to December 34, year 2. The market price now is $40. Grant date price was $30. So the appreciation per right is now only $10, $40. The total required balance in that liability account, reflecting the full 2 years of service and the current market price, should be $10 times 10,000 rights, which equals $100,000.
So the total target liability is $100,000 now, based on the lower stock price.
Right. But remember, we already put $75,000 into that liability account in year 1.
Okay.
So the compensation expense we need to recognize in year 2 is just the amount needed to bring the liability balance up to the required $100,000. That's $100,000 minus the $75,000 already there. which is $25,000. So the year 2 entry is debit compensation expense, $25,000. Credit liability for SAR plan, $25,000.
So the expense in year 2 is lower because the stock price appreciation decreased from year 1 end to year 2 end.
Interesting. Exactly. And now the total liability account on the balance sheet has a cumulative balance of $100,000. $75K from Y1 plus $25K from Y2. Finally, January 2, year 3, the exercise date. Mort exercises all his SARs. The market value is still $40. The company now has to pay out that liability it's been accruing. So the entry is debit liability for SAR, plan $100,000, wiping it off the balance sheet. Credit cash, $100,000.
And Mort gets his cash payout based on the $10 appreciation, $40 market, $30 grant price per right. Simple settlement.
Simple settlement, maybe slightly more complex accounting leading up to it. So wrapping this up, what does this all mean for you, our listener, when you see these terms flying around? We've looked at employee stock options, both the kind that don't create expense, non-compensatory, and the kind that do, compensatory. And we've also dug into these cash-settled stock appreciation rights.
Yeah, and connecting this to the bigger picture, really understanding these different compensation types is, well, it's crucial if you're looking at a company's financials or just trying to understand how they motivate and reward their people. Stock options, they give employees that chance to actually own a piece of the company, potentially profit from its growth, really ties them to the long-term view.
Skin in the game.
Exactly. Whereas SARs, they offer that reward linked directly to stock performance, but often as cash, without the employee needing to shell out money upfront to buy stock. And, beyond just the accounting, it's fascinating how the choice reflects company philosophy. Options often signal, we want you to be owners, think long-term with us. SARs, especially cash-settled ones, might be more common in private companies where selling shares is harder for employees, or maybe companies that want to reward stock appreciation directly without the complexities or dilution of issuing more shares. They solve different problems.
That's a great point. These methods, they don't just hit the financial reports, impacting profit numbers. They also really profoundly influence employee motivation, retention, keeping top talent. They're powerful, strategic tools, aligning individual success with the company's overall performance. It's not just about the salary. Well, that was definitely a deep dive. We've untangled, I hope, some pretty complex accounting concepts, hopefully giving you some aha moments about how companies pay their teams beyond the paycheck.
Absolutely. Maybe a final thought, something for you to mull over. We often get asked, how might that choice between these methods options versus SARs, compensatory versus non-compensatory, how might that choice reflect a company's broader financial strategy, or maybe even its deeper philosophy on what employee ownership or partnership really means?
Something to chew on indeed. Thank you so much for joining us on this deep dive. We hope you feel more informed and definitely ready to spot these concepts in the wild.